Well, let's go over here and look at it, and I'll show you what I'm talking about, okay? So we have this 3625 and 3620 binary. Now, these are weekly and daily binaries. You'd never notice this if you're flipping back and forth on the Nadex charts between the dailies and weeklies, okay? It wouldn't even register with you. You wouldn't even be looking at this binary. But with the binary scanner, it puts all the dailies, weeklies, and trades together so you can see what's going on. And what we can see is right here at 3620 is $2, which means it cost $2. If the euro-dollar were to rally up to 36.20 by 3 o'clock, then it would make $98. Okay? So you have a $2 risk and you have a $98 profit on this lower one. So minus 2. And then a profit potential of 98. Now, if we go in and go, well, okay, well, that's still a $2 risk. But what if we sold the 36.25? Okay? So if we go in there and we sell the 36.25, we'll highlight these for you. If we sell 36.25, we actually are going to make $2.25 on the contract. Okay? So if we make $2.25, so a positive 2.25. And if it loses, how much could it lose? Okay, so what's the max possible loss? Well, it'd be 97.75. As you can see right there, we have the max loss built in. So minus 97.75. So you can make 25 cents. Meaning if the market stayed below 36.20, you would make 25 cents because you brought in $2.25 and you paid 2. The market went above 36.25, then you would make 98, lose 97.75. Now, if it expired between them, okay, then you'd actually be able to go in and you would collect your $2.25 plus your $98, and you'd actually make $100.25 on a no-risk trade. So pretty sweet. It had to expire like right in the middle, right in between 36.20 and 36.25. Because remember, these expire at the same time at 3 o'clock. So it can't both expire above and below. It can't expire above 36.25 and below 36.20. It can expire between them, above them, or below them, but not above and below both. So $100.25 would be the profit if it expired in there. Now, why is this not arbitrage? I mean, this looks like arbitrage. It is arbitrage, except, and this is usually one of the biggest keys, either bid-ask spread or exchange fees. Well, bid-ask spread doesn't affect you. The reason being is because you can hold both of these to expiration, so you don't have to pay any bid-ask spread, okay? So if there's no bid-ask spread, you still have the fees of 90 cents aside. So if you paid 90 cents in, 90 cents out on one, and 90 cents in, 90 cents out on the other, then you'd actually be down $1.80 plus $1.80, so you'd be down $3.60 in fees, okay? And then you'd make, let's see here, we'll do that again, minus 3.6, and then you'd make 25 cents. So you'd actually lose $3.35. How would this be possible? Well, if there was, I mean, these are so far out of the money, there's no demand for them at all. Okay, if you did enough contracts, because on Nadex you can massively reduce your cost because your exchange fees are capped at $9. So if you're, as long as you're able to get your, do enough contracts that you got it where it wasn't costing you this much, let's say you did, 100 contracts or whatever, and you brought that fee down, drastically, then you'd be able to go in and, do arbitrage. So let's say if you could get your fees to where per contract it came up to, say, 10 cents because you did so many contracts. Then, you'd bring in 25, you'd pay 10, you'd net out a 15-cent profit. Anyways, that's just sort of a fun random lesson. It'll stay in your mind, and then you'll start looking for them all over the place. And every once in a while, you'll actually see some that are around here, like right in the middle, which is really ultimately what you want, right? So, the real trades that you can actually take. And, one of the things that I really like is I'll use this to go in and just to compare and see, what's available at a specific time. Like, so we got the dailies, we got the weeklies, and even like the, the 2 different dailies coming together. So, because right here, I mean, these expire at 3, but this is the 415s that start at 6 p.m. last night, the 415s that start at 8 a.m. this morning, and the 415s that started on Monday at 3 a.m. And it'll put all of them together for you, and that's what that W and that D is for, weekly, daily, okay? And but they all expire at the same time. They all expire today, Friday at 4:15. And so instead of having to flip through two different daily charts and a weekly chart, then you're able just to focus on one of them. And I'll show you what I'm talking about over here. If I pull this up, we go to indices binaries. And we'll go to the S&P. I say I have to be looking at the dailies, pull those up, and then go to the weeklies because they expire at the same time. There's no reason not to look at both of them. By doing this, you can see how they'll be intermingled because they have different widths on their strikes. They came out at different times, and so you got a lot more. You basically have a lot more choices, and you can find a binary that may better suit your trading strategy, especially on Fridays because of all of the additional contracts. Now, one of the other things I like to point out to people, because people are always asking about the spreads and how are they priced and things like that. So let's look at an example. If I can get you a good example, we'll see. Right here. And I'm going to drop gold off. There we go. Okay, so what we're going to do now, and I'm going to open up Thinkorswim. And I like doing this on Fridays just to sort of bring this point up, help people learn how the pricing works. And so they sort of understand that there's not just some random thing going on in the background. There actually is some consistency in the whole model of how it works. How do they price these spreads? And they price them really the same way they price options. From the floor up to the ceiling is like a call, a Black-Scholes model on a call. So actually up to the, I'm sorry, not up to the ceiling, up to the middle of the spread. So let's say it's 10 points wide. From 1685 to 1690, it's like a call Black-Scholes model. From 1695 down to 1690, it's like a put Black-Scholes model. Okay, and but it's on the same day. So let me see here if I can pull this up. I might be able. Here we go. And then bring this across on the screen. And what we'll do is we're going to compare them with S&P E-mini options on the CME that expire today. So we'll pull this up, and we'll say to show us, probably the middle 10 over here. Trying to get all this on the screen for you. So we grab like the middle 10 spread, or middle 10 contracts there. And then we want to find, ones with a similar floor, ceiling, strike, etc. So if I was going to go over here and look at, we'll say, buying a 16, got to widen that out a little bit more. And then what I'll do is I'll just shrink this up because I don't need that or that. Okay. So yeah, we'll just compare it like to say, let me find one that's a little better, more realistic that we'd consider doing. 1695, yeah, that'll work. Perfect. Okay. So if we look at a 1695 strike, and we look at buying it, okay, and we're going to bring this down to one contract. Okay, now if I do one contract on the S&P E-minis, that's 50 options. And so I'll hit confirm and send. It'll bring up, it'll show you the price. Now it's $2.90, and we're basically going to see the same thing. We're going to multiply that number times 50, okay? So confirm and send. We'll bring that up over here, okay? And then you see, okay, the risk is $140 on that trade. So that's on the, let's see, let me grab the screenshot. Okay, so that's on the 1695 call. What if I go to the 1695 strike? We can see, a similar pricing. Now this is 3 o'clock, so to get the best comparison, we're really going to have to look at 4. But $120 versus $140. Okay, let's see if we can go down. Is there a 1695 buy for 415? Because that's what we really want. 1680 is a 1685. Okay, well, we could do that, I guess. If there's any liquidity in the CME today on that, but we'll check. There ought to be some. And we'll go in here and see if we can find a 16. I said 85, right? So there we go. Yeah, 1685. Okay, that'll be a good example. because I want to get a 415. The reason I want a 415 is I want you to compare the pricing model. And I'll show you this when we come back, but I'll show you the pricing model at the exact same expiration time, the same amount of time to expiration. So we'll do this again right when we get back from this break.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
The Art of Timing the Trade Charts is the only software package available with a built-in Gartley and Butterfly pattern scanner that will scan thousands of stocks, ETFs, and indices each day to find these patterns and then make them available to you with just a single click of your mouse. Tom O'Brien and Dave White will be hosting a live event for all Art of Timing the Trade Chart subscribers on October 16th at 6:30 p.m. Eastern. And for a limited time, we're offering a promotion where new signups can gain access to this powerful charting software, as well as the live study session workshop coming up this Wednesday night for only $1. That's right, $1 for the whole month with the class included. Remember, this offer is only good till this coming Wednesday night when the workshop takes place live with Tom O'Brien and Dave White, so don't delay. For all the details, visit the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, we're going back here to the Diagnostic Trading Hour. All right, so what we're looking at right here is we have a contract. It's the S&P E-mini futures options that expire today at 4:15, and the 1685 call costs $10.75 right now, and you have to buy 50 of them at a time. And so the net result is the cost, not including commissions, is $537.50. Now, up here, we were looking at this. I locked in the price. It's went up a little bit, so they're all changing constantly. But at the same time as $16.95, so it was actually $500. In this case, it was $37 less than buying it on the CME. Well, what do you mean it was less? It's the same thing, right? You have a $16.85 floor, which means you can't lose any money below $16.85. Well, if you buy a $16.85 call, can you lose money below $16.85? I mean, your risk is capped, right? So in this case, at $10.75 a contract. So if it's going down against you, then that's the most you could lose. If it went, if the market went down 50 points, that's the most you could lose. Whereas on the CME, you could actually lose a little bit more. So, and the reason I do 5 contracts, okay, to make them similar, the reason I do 5 contracts on Nadex is to make it worth $50 a point, just like you'd be doing on the option where you have to buy 50 of them. For one contract, it includes 50 options on the CME. Well, one index spread would include 5. Okay? So I buy 5 of these, and my net max loss is $500, or my gross max loss is $500 on Nadex to buy a call, versus on the CME, it's $537.50 to buy a call. Now, why? Well, I mean, it's a Black-Scholes model. One, I want you to see it's efficient. Okay, that's the first thing I want you to notice, is this is efficient. It's very close in price to the CME, using a very similar price model. Okay? And, there is a cap, right? Yes, the US 500 doesn't make any additional money above 17.15. Okay, that's 20 more points in addition to the game we already have today. I think we'll be okay if we hit 17.15, because, again, you're saving money, okay? And we can even update. We'll update the price right now to the current live market price. We'll see where we're sitting at this moment. All right, that puts us at 545 versus 562.50. So, just commercial break to now, we're still seeing that Nadex is actually better priced for you than trading over on the CME. And here's what's cool about this. Okay. Well, what if I buy a 5-day, contract? Well, then you're going to be paying for 5 days of premium, which, if you know anything about option theta, options decay, time decays faster and faster and faster the closer you get to expiration. There's less premium in it, and it exponentially decays, especially in that last 5 days. So it starts really in the last 30 days, and it just gets faster and faster. Well, in Nadex, you're always getting that last day premium, which means you're always getting the smallest amount of premium. So 5 days on Nadex of premium is cheaper doing 5 spreads, if I say like doing a spread 5 times, Monday, Tuesday, Wednesday, Thursday, Friday, than doing a weekly on the CME. So just another very cool point. And of course, you can use these to hedge just like you could hedge an S&P E-mini future. So now one of the big differences is the smallest size that you can do on a CME E-mini future is 1 contract, which includes 50 options, meaning the minimum investment there being $562.50. On Nadex, I can actually divide this thing down and go all the way down to 1 contract instead of 5 to make it equalized. And I can choose only to risk 109, or maybe 2, or maybe 3, or maybe 7. So I can make it fit my risk model a lot more precisely than I would be able to if I was trading over at CME, because I'd have to do either 1 or 2 or 3. Basically, I'd have to do like blocks of 500. Whereas on CME, I can do blocks of 1. And again, after I pass 10, my fees are capped at 90 cents. Or, sorry, $9. Therefore, like if I do 50 contracts, my fee is a flat amount, and so I won't have to keep adding on, more fees and more fees and more fees. Whereas if I go and I trade this over on the CME, I'm going to be paying for each additional contract. And so hopefully that makes sense. But it's just sort of a cool lesson to see, because if you're into options, you're into things, you're trying to figure out, hey, is the pricing model legit? Is this good? And seeing this pop up like this, where you can actually look at the live prices and see that it does add up. And I mean, we can edit it over and over again. You'll see the same thing. And Right there, 550 versus 535 right now. So, right there on the call side, we see it adds up. We'll look at the put side when we get back from this break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Andy Hecht, the host of the Commodities Hour, recently launched his newsletter service, the Technomental Commodity Report, and only 6 weeks in, Andy has already recorded a triple-digit winner. Andy advised his subscribers to purchase a long-term call option at 46 cents on July 11th, and then sent out a special update Friday, August 16th, advising his subscribers to close that position at $1.40. That's a 204% profit in just 5 weeks. The Technomental Commodity Report by Andy Hecht is released each Thursday morning, and right now you can get a month-long free trial to this subscription while locking in the low introductory rate of only $39 a month. Andy Hecht has been a commodities trader for over 3 decades. Let his experience work for you. Sign up for your month-long free trial to the Technomental Commodity Report today at TFNN.com. Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Diagnostic Trading Hour. And price is moving around a little bit right here, but just to keep it on the same example, and I can open it back up. But just looking at it right now as the markets are fluctuating around, when I pulled this up, we had 1694.5. And what you can notice is 5 contracts to sell the 1670 to 1700. Okay? What gives us a max risk of $275. If I go and I do a put on the S&P E-mini futures that expire the same time today at 4:15, it's going to cost me $550 times 50. Okay, it's going to come out to $275. So in this case, they're priced exactly the same. Now, this isn't so much just the price is better, the price is worse, back and forth, all that stuff. It's more to just show you how efficient the pricing model is. And I might be able to go in right now, and maybe it'll be, let's see, I got 250 over here. If I reset this and look at the current price, let's see, what do we got? I think we're still at, we're at 550 now. So let me pull that over here. And now we're at $275 risk. Okay? So, on the exact same thing. Because, again, you can't lose any money above the ceiling, right? So when you're selling, you can't lose any additional money above the ceiling. Your risk is capped at $250. So just like when you buy a put, you can't lose any money beyond what you put up to buy it. So it's the similar same contract, and the pricing model being right there. We actually are getting better pricing right now at this second. Now the second they could go in and out, $10, $25, just as basically that's bid-ask spread fluctuating. But as of right now, you can see how you're actually getting better pricing. Over on Nadex, you're saving about $25 for an option that's going to expire today at 4:15 on the exact same thing with the exact same ceiling or floor, as we were looking at the calls earlier. So it's just sort of cool to see that. It gives you some confidence in the product to actually see that it's being priced fairly. And again, they're just using the normal option Black-Scholes model. The difference is this does have a ceiling, okay? So obviously, it's going to be a Black-Scholes like 1670 up to the middle, and it'll be a Black-Scholes 1700 down to the middle. Like on a put side. And whether or not you have any idea what that means, because I know a bunch of you are like, what that means to you, why do you care, is because you want to make sure when you're trading a product that it's fairly priced, that there's not, they're not just jacking up the premium, that market makers aren't just messing with you. Would I be better off just going over to CME? In this case, no, we're seeing that you actually are better off at Nadex, and you can fractionalize, you can do less than 5, whereas on CME you're doing 50, which is equal to 5 on Nadex, but the minimum you can do is 1 contract of 50 on CME, whereas on Nadex you could actually just do 1 instead of doing 5, so you could actually reduce your risk or fractionalize your risk to meet with your risk management plan. But anyways, it's pretty cool to see them line up. And the only day you can actually look at this really is Friday, by the way. The reason being is because Nadex has spreads that expire daily every day. So if you're looking at S&P, it expires at 4:15 every day. So Monday, Tuesday, Wednesday, Thursday, Friday. It doesn't have weekly spreads. And whereas on like CME, you'll have weekly spreads on there. And so you can't really go on Monday, look at Nadex, and then hop on Thinkorswim on Monday and compare the two. But you can definitely compare them on Fridays because they have the exact same amount of time till expiration, same strike, and you can see the price differential. So just a fun lesson of the day. All right, so that gets us caught up right there. And, we got the deviation levels. I talked about this yesterday. Just wanted to reiterate just so you knew, and we're checking them out. We've added 14 new currency pairs to our deviation levels, and we'll be bringing in, and hopefully the next 3 to 6 weeks, we'll be bringing in over 3,000 stock, ETF, and index deviation levels, and over 40 futures, and probably about another 30 currency pairs, depending upon all the implied volatility feeds we're getting. So we've already put the orders in for that, and I got programmers working on it. And depending upon how many different data feeds we can pull together, then we'll get it going. So that way, even if you're not a Nadex trader, you can use the deviation levels. And we were talking about this morning. Me and Tom were talking about this on Bull Bear Binary Hour. It's important just to have a true perspective, have a reality of how far something's going to move. Can it move more? Yeah, everything can always move more. But what should you expect? Because you need to play the probabilities. And that is what trading is. When it comes right down to it, it is trading the probabilities. And you don't need to have a whole lot of expectation of movement beyond the higher probability movements. So let's look at some of those movements right now and see what we got. Okay? So over here we can actually see the Dow hit one deviation, and it's really important that you understand this concept. Low to high. Okay, not just the deviation level, but low to high. And so one deviation move on the Dow is going to be settlement to either a -1 or a +1 move. Okay? So that's, basically 168, 170 points. Well, if we go low to high, we're at like 217 because we went down to -5, went back up to +5. So at that point, you shouldn't expect just a whole lot more movement in the market. Now, you can keep trading it, just trail your stops, and that's not the point where you start adding in like crazy, okay? So you don't want to be thinking, oh, this thing's going to go, to the moon or whatever. I mean, even with the big day we had yesterday, right, Munster Day, the deviation levels kept you in check. 3 deviations is like a 99.7%. It's not going to go that far. And, we got like 97% at 2, and then we have like 70% at 1. So basically 7 out of 10 days we expect it to stay within 1 deviation, and it does. A large, obviously, 70% of the time. So today we can see it went a little bit outside of that, which is great. That's, if you're in the trade, you're able to trail your stops and, keep riding the trend. But you're probably not adding in right now. If we go on over, we can check out a couple of the other indices. Let's see how they're stacking up. We had that drop after they came out and said they, didn't come to an agreement, and then everything ran back up afterwards. We can see the Russell sitting right now perfectly at 1 deviation. And we had a 2 deviation move yesterday, a rare event, but we had it, and notice how it hit right at that line. If we go on, we can look at, let's see, the S&P. And on the S&P, if we go into that, just waiting on it to show up here. Yep, so we got down almost half a deviation, and then obviously exceeded half a deviation on the upside, so we got a full deviation move right there. And let's go down and look at a couple of these other markets. So soybeans had a pretty good move today. And sort of interesting because I wonder if just a lot of traders went in and traded despite the lack of the report. Yeah, you can see sort of a gap right there. Market moved down, but look where it's sitting at right now. Okay, it's sitting at 1 deviation. These were posted at 8:15 last night. Okay, so sitting at 1 deviation. We're also getting a spike reversal right there. So right there on the 5-minute charts on soybeans. So it would have had an entry at this point in time. So we're a little bit late on the entry there. Had a great spike reversal. You see how it spiked up on the volume as it hit the deviation. That's a good point where you can expect some potential pullback when it's a 1 deviation move. I don't play every deviation. I do know some traders starting to play some highs and lows. But my preferred is when it's a 1 deviation move. And so we definitely got that right there, and you can just see it. It's perfect. Let's check out corn. Corn was not as volatile today. And these are just ags. So, I mean, we showed it on indices, so we're checking this on different markets, just seeing how it lines up. And so on corn, we got to move down. And today it stopped at 0.7, so it didn't even quite make a 70%. It stayed within the 70 percentile, which means within the 1 deviation. But it did at least stop right on and pivot right on the deviation level. Now let's check out some other markets. Let's see. We had some big moves right this morning. There was that big Nadex report that showed that CME, COMEX actually stopped filling orders for 10 seconds. And right in this little gap zone here. And check this out. That happened. It busted through 1 and 1.5 during that whole 10-second crash thing that was going on in gold. And but then it stopped right there at 2 deviations. Bam. And it's perfect bounce play right off the 2 deviation level. I mean, it literally could not be more perfect than that. Go down here, go down to silver, which, I mean, you can use these for reversals, contrarian trading. You can use these for, which is what you would have done on gold there. You can use these for, your trend trading for tightening your stops. So there's a lot of different ways you can use them. But I mean, notice like right here, see silver bust down, hits 2 deviations. We get a volume spike, and it starts moving on back up. And it's a perfect reversal trade. Yeah, I mean, that literally you can't get a better trade than that. Perfect reversal trade. And right off the deviation levels with the volume spike. And the volume spike I define again is simply a volume bar at a deviation level whose volume bar before and after it are half the size of the spike. So basically, whatever this one is, the bar before it and the bar after it are half. And let's see, let's look at copper. We don't pull up copper that often. Check it out. And you can trade this on Nadex as well. And silver, copper, and NASDAQ are contracts that you can trade. They're not my favorite contracts because they don't move as fast in the sense of they have larger point sizes. But if you're a new trader or if you have a small account, they can be good for you because it also reduces your risk while you're learning. I'm looking at copper, so it moved down to half deviation, and then it moved up to half a deviation. And notice that we got a volume spike right there, right at that deviation. Gives you a great reversal trade. So and you want that. You basically want that spike where it's closing up right there. You get that big volume bar in between the two other bars, and then it starts doing its pullback. And so right here, you're able to enter in, and you can do premium collection on these, or you can do out of the money. So like I may go in, I may sell a strike that's up here. I may go in and target the next deviation level, say that's down here at settlement, or I may do both. So that way, if it does go down, I make even more. But if it stays flat, this one, the premium on this one covers the premium cost on the one below it. And let's see, what else do we got? We'll go ahead and check out oil. So on oil today, and we can check out some currencies as well, but it's just sort of, it's interesting to see how these work out. On oil, we had to move right down to one deviation. I mean, it spiked it hard right there. See that? It's bam, and almost at 1.5. It pulled right back up to it, and literally is just hovering at one deviation right now. And it even gave us a little, volatility spike right there for potential reversal trades, giving us 2 of them now for oil to be able to go up. And I'm doing that again at the one deviation level. So how would I do that? What would I do? Well, like I said, we should have been in this trade earlier. It's about 12 ticks higher. But let's just see if we can find anything that might work on this trade, because when you're on air, you only got so much time you can do things, so you can't always just have the chart up and rocking with it there. But so what I do is I'll go up here, I'll go to the binary scanner, and we got to choose oil. And then I go, okay, what would I want to be targeting? So I'll probably shrink this up so I can see my chart at the same time. Okay. And how much time do I want? So probably 101.83 would be my target. I can buy that 2 o'clock. It only gives me 15 minutes. It's like $6. That's a pretty far move for, that short period of time. Let's see here. What else do we got? 101.50. That's 51.50. That's pretty much where we're at right now. It has a big gap in it. All right, well, so I don't see a great deviation. I said it a little earlier. We could have bought that 101.50 for a lot less. We probably could have bought it for like $20-$30. Right now, it's pretty much at that market price. So if we were in basically what we'd have done is whenever it broke the high of this bar is when we would have got in, and we would have been good to go. But that would have been about 15 ticks ago. So a little bit late to the party on that one, unfortunately. And 102 is definitely, that's really, it could easily shoot that high, but that's really pushing for it. End of the day, I really like this one over here. I just don't like the fact of how little time we have for it to get there. So you'll notice how fast they will move, though. If it starts moving in our direction, and I'll put one on just as an example. We'll see what happens, and we only have 15 minutes. It's only $4. So, but go in here and put this trade on. There's only a couple contracts in there anyway, and so basically what would happen on this contract, okay? And I would also go in. I'd set a sell side for a 57. Okay. So that way it'll take profit when it gets up there. And how do I put this? The way this works is if it gets to 101.84, what's going to happen is it's going to take profit, which is right at my 0.7 deviation level. Now, the downside of this is it has to do it in the next 12 minutes. So that's why it's so cheap. That's why it's only $4. The good thing is we're bouncing off of one deviation. We're coming closer to the end of the day, which brings in some volume or volatility, and we also have the volatility spike. So I probably would have preferred to get a 130 or 230, and the only way we're going to get a 230 is if it pulls back, quite a bit for us. We could look at a potential 230 trade, and let's see here. And no ARB on that one, so you'd have to pay $4 and only get $1.50. But yeah, you have to be shooting all the way for 102 to really get any kind of good risk-reward trade on right now. So we'll move on that one. I got that one on. If it hits it, great. If not, that's okay. That's one of the things I like to do is you can get really good risk-reward trades going. And natural gas. So we'll pull natural gas up over here. And there we go. All right, so natural gas, check it out. One deviation right there. Perfectly hitting it. So I'll let you know, hey, the day is done. So, and didn't quite get a volume spike. That's probably like 55%. So that one's, you're going to call that. You may go, I'm going to call that one a deviation and go with it. Just because, if we look at the two volume bars, we got what on this one? We have 258 and like 483. Yeah, so you're talking like 30 contracts off of 50%. So you could have traded that one as well. All right, stay right there. We'll be back after this break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Are you ready to ride the next bull market wave? Catch the Chapman Wave. Using the Chapman Wave methodology, Basil's very comprehensive daily newsletter, The Opening Call, gives the short, intermediate, long-term analysis for the key indexes. In his Trader's Corner, he gives a brief market summary and expectation for the day with possible trades, both long and short, which are reviewed daily. A position subscribers sold recently for a 42% on part, plus a 64% on rest. At Hertz Global as a core position for 6 months before exiting the position. A current position entered as a turnaround company with good technicals based on Basil's waveform is trading up to 170% of its entry point as a portion sold earlier for a 21% gain. Subscribers to the Opening Call can see the Chapman Wave techniques demonstrated and explained daily to educate investors. To get your 2-week free trial to the Opening Call, just visit the front page of TFNN.com. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday at 11 a.m. Eastern on TFNN.
TFNN has just announced a special sale for 2 weeks only for the Gold Report. To celebrate the 600th weekly issue of Tom O'Brien's Gold Report being published on October 22nd, TFNN is having a special one-time sale. From now until October 22nd only, you can receive 60 weeks of the Gold Report. That's 14 months for only $600. We're offering Tom O'Brien's dynamic weekly newsletter at only $10 a week, which is almost half off the regular monthly price. The Gold Report is published every Tuesday and provides subscribers with Tom O'Brien's expert commentary on the industry, as well as detailed information on a variety of mining equities. Take advantage of this one-time special offer and pay only $600 for 60 weeks of the Gold Report. This offer is valid for current or new subscribers. Everyone is welcome to take part in this special promotion as we celebrate the 600th weekly issue of the Gold Report. All the details are on the front page of TFNN.com.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
folks, welcome back here to the Diagnostic Trading Hour. And we're just looking through and checking out where all the markets are right now. We got the dollar CAD also down right there. We got one deviation. Now, dollar CAD had some news come out this morning. They had their employment change and unemployment rate that was released at 8:30. You can see when the news was released. It's pretty obvious right there. And we got just a mixed bag of results this morning. Ran right back up to settlement. Only got about 13 pips. Then ran on back down and got about 25 pips down from high to low. Usually we get about 80 pips on that report. The number came in better than expected on the unemployment rate, and the employment change was worse than expected. So basically what happened on this report is we had a good and bad report at the exact same time, therefore neutralizing the effect. Often we don't get both of those at the same time. But we got a good and bad report simultaneously. Last time we got good employment change, good unemployment rate. The time before that we would have got bad employment change, bad unemployment rate, and before that they've lined up. So usually they're lining up, or one of them's at expectations, but one was much better and one was much worse than expected, therefore resulting in giving us a mixed trade. So when we saw that mixed trade result and no revisions prior, then that was your clue to get out of the trade as quickly as possible. So you would have had a little bit of time. If you go down, you can shrink that down to a minute bar and just sort of look at it. But that's really what you're going to be looking for. You want to get it as quick as you can if you see the results are mixed. That more than anything, that is probably the biggest reason to hop out of one of these. Now, if the results are, a little bit positive, a little bit negative, you can watch it for a little bit. Maybe give it 5 minutes, 10 minutes, 15, see if it goes. Also, look and see if there's any revisions previously as well. But you definitely don't want to go in. That's taking a while, that chart to load. But you definitely don't want to get in there and basically just get hammered because you hold on to the trade. So make sure you are looking and know, okay, is there any mixed reporting to worry about? And if we go over here, let's see. Now you can see right there at 8:30. Report comes out here. You probably got in a few minutes before. Okay? Report comes out, basically shoots up. You have about a minute where it's just oscillating. You might have been able to get out of close to a break even on the long side at that point. Maybe you lost a little bit because the implied volatility had come out. So you made a small loss. But if you held on and waited, it literally, in this case, just a couple minutes, it would have flown down. The long side definitely would have lost. The short side would have actually got some of its premium back. But, really not the best dollar CAD trade there. But, hey, not too surprising with everything being the way it is right now. It's just throwing everything off, including news next week. So we'll be finding out as days go on and as the weekend goes on what may or may not be announced next week. As a reminder, we do have we have Columbus Day Monday, and so some of the markets are going to be closed. And let me see here. Got a list so you can know what they are. Let's see. We got the U.S. bond markets are closed. The stock market is open. The CBOE is open. The CME floor is closed for interest rate and FX products, meaning you won't have FX volume. Okay, but Globex is open. Canadian stocks and bonds will be closed, and there's also many Latin American countries that celebrate holidays on this day as well. And of course, FX never closes. But just pulled that one up off Financial Juice there. I love it. It's just a free, great informational website where I can get things like that right there. Just know, hey, bonds are closed. So, all right, well, I hope y'all have a great weekend, and I will see you next week. Stay tuned. We have another great show coming up for you right after this.
What's the one thing that pulls people back from the breakthrough that they're moving towards? What's the only thing that really stops people from taking action? You and I both know the answer, and sure, we can come up with the reasons why we're not where we want to be, but the only reason that we don't do more with our life is fear. Or if you're an overachiever, call it stress. Simply put, there's something that happened to us in our past that's holding us back from the life we deserve, yet you and I are okay, we're here. So why should we let our past control our future? Exactly. We shouldn't. Hi, I'm Steve Rhodes with TFNN.com, and when it comes to your trading and investing, I can help you overcome your fear of loss. Together, we'll turn weakness into strength with a system I've developed called Mastering Probability. I'll teach you how to make your money work harder for you than you do for it. I'll teach you the tools that provide financial freedom. Go to the homepage of TFNN.com, click on my name, Steve Rhodes, and begin your journey of mastering probability risk-free. It's time to become a pioneer of your future versus a prisoner of your past.